is up about 1.5%. But let's do one thing. Let's get a quick check on what's happening with different businesses. We have the NBFC space on our radar now. Can Fin Homes, one of the strongest in its space, is upcoming now for you. Girish Kousgi, the MD and CEO of Can Fin Homes, joins us to discuss their business outlook. Girish, good morning and thanks for joining in. Dispersals remain very robust. Can you tell us what is the incremental ticket size that you're looking at versus perhaps what the average ticket size was in the last 6 months? Has it gone up? And what are the growth rates for the company now?
Good morning, Sonia. I think since last October, it's pretty robust. Demand is quite robust across all profiles, all segments, across geographies. And if you look at, I cannot talk specifically about numbers because we are in silent period, but I think generally if you look at the trend, it's been pretty good. I think every quarter we are clogging, highest growth in terms of book and disbursements. And this is coming in from all profiles, whether it is salaried or SENP. SENP was quite low after COVID first wave. I think slowly it's picking up. I think as of Q2 is concerned, it was about 74 salaried and 26 self-employed. Earlier, at a portfolio level, it used to be about 70 and 30. I think very shortly that will be back to 70 and 30. I think it is pretty robust. And earlier our ticket size was 18 lakhs. And last year we had a pricing strategy to compete with some of the big banks and HFCs due to COVID and a lot of restrictions in terms of generating new business and also to retain existing customers. That helped us to get into new segments, new markets, which actually helped us to increase our ticket size from 18 lakhs to about 22 lakhs. I think going forward, 22 lakhs, I think would be quite stable for a company like Can Fin.
Mr. Kousgi, good morning. I appreciate you can't talk numbers, but qualitatively, will the operating profit and the net profit, which got bit hurt last quarter, I think, would that get back to the normal trajectory?
In fact, I've been saying this since last 4 to 5 quarters. Whenever NBFC or HFC drop rates, for next 2-3 quarters, you won't see any impact on the revenue or on profitability. That's because of the lag effect, because the rates what you drop will start with incremental business and then slowly catch up with the entire portfolio. And therefore, after a couple of quarters, you will see margins shrinking and revenues dropping. If you look at this year, from April till now, we have increased rate twice, which means the trend reversal started from Q4 of last year. And if you look at till Q2, I can talk about, if you look at quarter on quarter sequentially, margins have been expanding, revenue has been increasing, PAT has been growing. So I think it's a trend reversal which happened about 3 quarters back. And I had mentioned that going forward, I think on all the parameters, whether it is absolute numbers or in terms of percentages, definitely it will be on the higher side because we have increased rates. And in next quarter or two, rates I think will increase. And any NBFC or HFC definitely will do well on margins in an interest rate increasing scenario.
But I mean, there is competition, right? So you cannot. So that puts a cap on margins. So what is the balance between growth and margins going to be? I mean, will you be able to hold margins? What does that do? What does that mean for asset quality as well going forward as you pursue growth?
In terms of balancing, I think we've done that very well for last many decades. Can Fin has demonstrated the wherewithal to build book at a higher yield and still maintain profitability, which has only improved in last 7 to 8 quarters. In terms of competition, I think now we are well placed in terms of taking on. And if you look at our balance transfers out, it has come down drastically. In terms of asset quality, after restructuring, I think it is well settled down. And if you look at last 7 to 8 quarters, I think for Can Fin, NPAs have been dropping in terms of percentage. So I think that trend, I think, should continue for all good companies in the industry for next few quarters.
Since you mentioned interest rates, could you tell us, according to you, where will interest rates, how much will interest rates go up by? Lending rates for the sector, for your industry in the next quarter, 2 quarters?
Maybe in next quarter or two, I think rates could go by about, I'm talking about repo, it could go by about maybe 0.25 to 0.3%. In terms of long term, let's say next 18 months or so, it max could be about 100 bips. I think that is easily which as a company we can easily absorb that.
Okay. particularly for the salaried class, since your loan mix is skewed towards salaried class. What kind of growth have you seen there? Because in the quarter gone by, it was, I think, about a 23% growth on a year-on-year basis. But going forward, what are the big trends there?
I think earlier I told that as a company, we are looking at 18-20% growth both on book and disbursement. And when COVID started and when recovery started from October onwards, we saw very huge demand from salaried. SNP was quite low. That's because of COVID impact. And salaried demand is quite robust, whereas SNP is picking up. So overall, if you see, I think the entire industry will do very well this year compared to last year. Last year, obviously 2 quarters, the entire industry lost. And this year, because of wave 2, there was loss of about 20 odd days. But nevertheless, even if you discount that on a like-to-like comparison, this year would be far, far better compared to last year, assuming last year would have been average, notwithstanding COVID.
Mr. Kousgi, what about this co-lending model? You would have seen the news of SBI, this co-lending mechanism with 5 housing finance companies. Your thoughts on that, and whether you are looking at something similar?
I think today as a company, we have maintained cost leadership. And as a company, we have demonstrated that we want to grow our book. So keeping these two in mind, we don't have any idea of getting into co-lending arrangement, at least for next few years.
Okay, no idea of getting into co-lending. Just finally, can you help us with what the average cost of funds was in the last, say, 1.5 years compared to what the incremental cost of funds is now, and what are you targeting by the end of the fiscal?
Incremental cost of funds is sub 5%. At a portfolio, it's about 5.77%. So, which I feel that in next quarter or so, it will start inching up. And we will cover that up by increase in yield.
Okay, all right. Mr. Kousgi, we'll leave it at that. Thanks a lot for giving us a quick check on the business and the way forward. So demand is very robust, and they continue to expect an 18 to 20% growth as far as their disbursements are concerned. Well, for the market, any thoughts? I mean, it's all over the place, sort of yo-yoing, but now the mid-caps and the bank nifty have once again seen a buy on dips.
Absolutely. I think it's playing out, the market's now inching up quite a bit. And, Sonia, what's clearly working is momentum. Look at stocks like GNFC, for example, that's doing well. Tata Consumer, Motherson is making a bit of a comeback. Tata Communication, even this Canfin Homes is one of the best-in-class companies in this space. That's doing well. So a lot of individual stocks seeing quite a bit of traction right now. And we are at what, 17,548 now. I think perhaps today is the last day of the financial year as well. My sense is that there will be some volatility post-noon, especially because it's monthly expiry as well. But for now, holding firm, Sonia.
All right, let's dip into a short break. On the other side of the break, we'll have a discussion going on the real estate sector. Prashant Bindal of Macrotech Developers and Gulam Zia of Knight Frank will discuss the impact of rising commodity prices on real estate and the overall demand trends. Stay tuned.
A vision